All right. Hi, everyone. Good afternoon. Thanks so much for joining us today for unlocking the possibilities of the digital credit ecosystem. My name is Maria. I'm the CEO of Tech in Asia, and I will be your moderator today. So in today's session, we're going to be talking to four experts in this space, and we're going to break down the digital credit ecosystem, including the major trends, players, and tech that are starting to change this space, as well as the discussion as to why digital credit is so important for any fintech companies out there and what the remaining opportunities are for Southeast Asian fintechs. So let's get started. We will have plenty of time for Q&A later. So if you have any questions, drop them into the Q&A tab and the panelists will go through as many of these as we can at the end of the session. So first off, let me please welcome Mohan. He is the Managing Director for Southeast Asia Regional Innovation, BI, and Analytics for Experian. Next up, we have Ed. He's the co-founder and COO of Latitude Pay, a fintech in this region. Let me please also welcome Ankur. He is the Managing Director and Head of Lending for Grab Financial Group. And finally, we have Arvid, the Head of Partnerships and Strategies for Tomorrow Digital Group at UOB. Hi, guys. Thanks so much for sharing your time with us.
Hi, pleasure, Maria.
Pleasure. Yeah.
Awesome. All right. People are starting to fill up the chat box, dropping where they're from. So that's great. Hope we keep that energy up. All right. So let's get going with a quick definition and kind of setting the playing field and understanding for everybody here today, and define what we mean by the digital credit ecosystem, and as well as the key players that we should take note of. So Mohan, if you can maybe kick us off, can you share with us your take on what the digital credit ecosystem is and some major trends that you're seeing emerging in this space?
Sure, Maria. I think it's important as we are looking at the digital ecosystem that we also look at what's been happening the last couple of years that's led us to this. The first is obviously the fact that with digitization growing in general, we've seen an increase in the amount of data that's available on consumers online. Most of the data that we used to work with in the past was offline data that's moving to online data that's available. So that's one big trend that we're clearly seeing happening. The second thing that's happening is the analytical capabilities, AI, ML kind of models that are in play are letting us get insights on consumer segments and on consumers individually way sooner and taking into account a lot of the data that I talked about earlier in a much more comprehensive manner than in the past. The order of magnitude of these changes are quite dramatic. I mean, I remember the first time, a long time back when I built my first scorecard. It was an 8-month project, and today, if we take a couple of hours to build a scorecard where we have the data prepared, I think that's like a timeline overrun for us at this point in time. So clearly, the technology underlying for build a scorecards, build of consumer insights is comparatively undergone a big change. I think the third thing that's happened is also the infrastructure available for real-time decisioning has grown a whole lot. Cloud is ubiquitous. Most of the newer players are using cloud or extended ecosystems that are making these decisions closer to the consumer. As a consequence, it's a combination of these three factors in some form together. The consumers need to go more digital. And of course, the fact that the pandemic seems to have accelerated all of this. That's leading us to this place where we have this digital ecosystem growing at the pace that it's growing at right now. I think that's a good way to think about the overall space at this point in time, and also to talk about the different players there. If you think about this again, there are obviously the data contributors who are players. There are the players who are building the digital ecosystems, and there are the players who are the technology providers who are providing either the infrastructure or the technology capabilities associated with all of this. So I think it's a coming together of all of these that's contributing to everything that we are seeing as a force multiplier that digital credit seems to represent.
For sure. So it's definitely a confluence of factors that are creating such rapid innovation in this space. And you've already started to touch on some of these players. Arvid, can we maybe get your thoughts as a follow-up to this, Mohan's point, sharing a breakdown of the different players in this space, and then as well as new ones that are starting to come into this space, perhaps enabled by these tech trends?
Yeah, certainly, Maria. So agree with Mohan's points, I think, and I'll build on that. I think there's four main points. So I think the customer is first, and there's obviously a lot of changing customer needs, especially in this part of the world in Asia. There's this access to credit, which is a real pain point. Take markets like Indonesia, for example, where there's low single digit credit card penetration. And I think this financial inclusion angle and addressing kind of this upperly mobile middle market segment, which is rapidly growing, is actually a huge opportunity from a customer perspective, but overall from a market perspective as well. So the customer is the key driver as far as I'm concerned. The second is the platform. So I think I would categorize this into the players that hold data that can provide complementary data for credit underwriting. Some of the large platforms hold some of this data. It can be at telcos, utility companies, things like that. I think they provide customer reach and that enables that credit. And there's a lot of use cases around actually figuring out how to provide credit seamlessly through some of these platforms through an embedded finance type of way. The third are the financial services players. It can be the fintechs, it can be banks. They provide balance sheets, sometimes licenses, risk management, the credit subject matter experts. So I think that's obviously a key enabler and historically the key driver to kind of make some of these things play. And then last is regulation. This is obviously a fast evolving space. Buy now, pay later is a hot topic, and I think that's rapidly developing. And there's views being taken globally across markets about what this should be, ultimately coming down to customer protection and making sure that we can provide financial inclusion, but in a prudent way. So there's a lot of things emerging, whether it's regulatory platform players that want to play in this space, banks trying to figure out how to extend the value that they've always been offered, and then the customer, which is rapidly developing their own views and utility from this whole thing.
Absolutely. And while we have you, can you maybe share a little bit more about what you're doing with the Tomorrow Group?
Yeah, certainly. So Tomorrow, I'm part of UOB's Tomorrow Digital Bank. We launched the digital bank in Thailand and Indonesia over the last 2 years. We've just brought this back to Singapore, actually. This is part of a wider regional strategy to digitize UOB from within. The digital bank was always a key part of that. At first, serving a fairly narrow target segment, the YPF, the digital savvy millennials. Over time with COVID, this has actually evolved a bit because we're really looking at a wider spectrum now. The wider spectrum is the digital generation and people that consumed a digital quite naturally. So my role was heading strategy and partnerships for this. And partnerships are obviously a very natural alliance when it comes to extending reach, gaining customer acquisition, extending credit, and things like that. So we're rapidly growing across our markets where we've launched at Tomorrow and bringing back some of these competencies which we've built from within and sharing this with a wider bank to drive overall value.
Awesome. Thank you. All right. Now that we have a background of the landscape a bit, let's kind of dive in more into some of the trends and as well as, the evolution that we're seeing in this space. So according to a recent Deloitte report, the pandemic has dramatically accelerated the rate of digital adoption in financial services. I don't think that would be surprising to anyone. So Ankur, let me bring you into the conversation here. Maybe if you can help us provide a then and now comparison over the last 2 years, how has the digital credit ecosystem changed and how has the impact of the pandemic kind of shifted the consumer demands that you're seeing at Grab?
Sure. Thanks, Maria. Pleasure to be here. And well, certainly the pandemic has completely accelerated the pace of digitalization in Southeast Asia. I mean, there's no doubt that's happening. That was already happening even prior to the pandemic, prior to 2020. But 2020 pandemic was like a shot adrenaline in the arm. And that's across the board. We're seeing that whether it's for consumers who are first-time transactions on digital platforms have really shot up during this time, or the micro merchants and the SMEs, or the banks, and even regulators and policymakers. The number of policy conversations that we've seen during this time where regulators are more open to the conversation about, okay, how to provide more digital KYC, how to provide a more digital journey for onboarding customers is amazing to see, right, as well. So we see that happening. And during the same time, we've seen mass number of SMEs and merchants come on board on the Grab platform. So for example, in Grab platform, we've onboarded about 600,000 SMEs or micro merchants, largely traditional, who were operating in a largely traditional space, now have come on board on a digital platform. So these are people, or these are small businesses who were probably operating in a cash economy before, which is largely invisible to the digital economy. If you're operating in the cash space, our ability to understand or drive insights from any digital data, or do automation, or do any cool stuff like AI and machine learning, which Mohan was talking about, is negligible, right? But once they are online, there's a lot that can be done. And that's what we are seeing happening during this time. The second thing, and true to that, is during this exact same time period, of course, as you would expect, when with lockdowns, many of these micro merchants were struggling and strapped for cash. If you do not have a traditional credit history, operating in the traditional space, in brick and mortar, in cash, then it's very hard for traditional institutions to underwrite. That's where we were able to, Grab Financial Group was able to kind of plug the gap and provide substantial small business loans during these times, which is largely on the back of our ecosystem data, on the back of the alternative data that we see that flow through the system. That just won't be possible in a cash-enabled or in a non-digital economy, right? Or ability to do that at scale will just not be possible. Whether we talk about the underwriting and access, the reach to of customers that Arvid was talking about, or our ability to judge their credit and underwrite the credit, deploy capital, and then collect money as well, right? So these all different, the value chain of lending is just wouldn't have been feasible without these players coming on board into the digital economy. And this is the amazing space where it's very heartening to see the value that we were able to add during this time to many of our merchants who otherwise would have really had to shut down their doors without access to this credit to bridge the gap, right? And I think ecosystem players, the platform players that Arvid was talking about, is definitely an area where we have an advantage. Platforms like Grab has an advantage because we have tons of millions of engaged SMEs or consumers, if we're talking about that space. Lots of data on these businesses, about the businesses, regarding their earnings, consumer reviews, transactions through payments that flow. So this allows us to underwrite. The fact that there's money flowing through our system, we are able to ring fence, and we're able to do daily deductions from the income so that they don't have to keep the SMEs don't have to keep a little savings account on the side till the end of the month to repay. And if they forget to repay, there is exorbitant fees or late fees. All of it is flowing through the system, all automated. And of course, our ability to do this at scale is there because of our low customer acquisition costs, our low deployment costs, low cost to serve these customers as well. I think that's where we see the change happening pre-pandemic versus now, where many of these people who have been even invisible to us or platforms like us, and certainly to larger financial institutions, are now becoming invisible. And that's where the opportunity lies in leveraging such insights to be able to build financial inclusion across markets in Southeast Asia.
Yep, absolutely. So I think you spelled that out quite clearly, which is Grab was able to leverage on the information that you already had, building this data profile and an understanding of each individual customers, and then giving you confidence in terms of the lending and the underwriting as a result.
That's correct. Yeah.
Awesome. Ed, maybe we can bring you in as well. So if you can give us a quick overview of Latitude Pay and how you kind of have spotted your gap in the market and where you're trying to innovate. And then as part one, and then the follow-up to that would be sharing your thoughts as to what a responsible digital credit ecosystem looks like and what the importance of that is to fintech players such as yourself.
Yeah, of course, Maria. From our perspective, there is no question that the rapid uptick of digitization has led to massive innovation in the way credits deliver. And I think this is really driving a change in a range of financial services now that consumers are expecting a level of transparency and accountability that didn't quite exist before. Like specifically, like at a time when the tools and technologies that capture customer data proliferate and penetrate into every facet of our lives, consumers whose information is at stake are increasingly demanding companies like ours to safeguard this information, as well as use it responsibly. And like Ankur pointed out, like regulators actually really around the world who are charged with consumer advocacy are also really taking an unprecedented interest in privacy and in consumer protections. And, needless to say, I mean, this is very important. Just take Bnpl as an example. Like in the UK, where there weren't a lot of regulations around what were the limits to digital credit, which really ultimately led to consumers getting over leverage. And then there were very draconian affordability regulations that came into play. So, there was a lot of learning from the UK experience that we can all kind of take it to heart. Like we believe, at Latitude Pay that the industry really should proactively regulate itself to not get into situations like that happen in the UK. We focus extremely heavily on the concept of affordability. We feel that it's really our moral duty, especially in a market like this where incomes are significantly lower than our Western counterparts, and that the products that customers want to buy are essentially the same price. So, affordability is absolutely crucial to the long-term sustainability of not just our business, but the entire industry and ecosystem. So, at Latitude Pay in Singapore, we also work very closely with MAS and SFA in this regard. We're forming an industry body, a working group to shape our code of conduct. We don't really want to make the same mistakes in the UK here in Southeast Asia. So we don't want to have the loopholes that can lead to abuses. So it's actually our duty and responsibility to drive healthier credit behavior and best practices in consumer educations. So, we in the industry can have the kind of responsible growth that's safe and sustainable for everyone in the ecosystem.
Okay, so at Latitude Pay, y'all have decided to kind of like move yourselves ahead of the regulation and basically not wait, future-proof a lot of that. Do you think that most fintech startups are thinking in a similar ways, or are they kind of just waiting around for the regulation to potentially, tell them what to do down the road and taking advantage of the lack thereof in the meantime? What do you see across the industry?
I mean, I think, and I can only really speak from our experiences in the Bnpl side, right? I think countries that kind of took the more relaxed approach, we've seen the kind of like, growth, and then a regulator kind of like sidestepped back in and stunted the growth in the back end, right? And this is kind of what we've seen in Europe right now. And in our stance, I think it's beneficial, to be proactive, to self-regulate rather than waiting for the regulators to come in that lead, due to like, abuses in the systems. But that's kind of how we see it.
All right, fair enough. Mohan, so, experience is where I think a lot of these different issues kind of start to tie together. And you guys sit at the intersection of a lot of these various topics. So maybe can you share some of the biggest challenges that Southeast Asian online lenders currently face, as well as how an improved digital credit ecosystem can address some of those pain points? Sorry, Mohan, you're on mute.
Had to happen in the panel. No, I was just going to say that to an extent, and Arvid talked about this to start with, where he mentioned the fact that we are at a low financial penetration rate. Financial inclusion is at a fairly low rate in general in Southeast Asia. So that's, I think, the starting point of what we see as the issue, that's the genesis of maybe the opportunity in some form. The key issues for the industry to address, as I see it, is on a couple of planes. The first is obviously the complexity of the whole model. The earlier lending model was one where lenders would typically wait for the sort of with a passive decisioning structure for the consumer to come with their decision, and you had the liberty to make it and give it to them at that point in time at leisure. to an offline process. First is, I think, just the challenge that all of these are now having to be done real time. So if you take what Ankur is talking about or what Ed's talking about, most of these decisions at the consumer level are now starting to get taken at the place where they are buying these digital goods or goods digitally, and at that point in time, you need the decision to be available to the consumer, which basically means extending decisioning real time. The way we sort of call this is we refer to it as edge decisioning as much as we talk about edge computing. This is to take the decisions to the place where the consumer is actually buying or making the buying decision. And I think that's a big challenge for this industry. A lot of Southeast Asia has actually been very dependent on physical infrastructure, and the last mile connectivity has always been a bit of a challenge. So while we are looking at the sort of dividends that are coming to us from digitization, I still think that that's the second zone of challenge to be solved for, which is making sure that the entire end-to-end process is as smooth and as digitally available to the consumer as is possible. I think there's a next level of problem, which is fundamentally making sure that the consumers are appropriately educated. And again, maybe this speaks to its broader point on consumer education, also data privacy, and so on. APAC actually has to play this, and Southeast Asia has to play this delicate balance between data privacy and making sure that financial inclusion is available. The more data you make available, the more you can make decisions on consumers. The more you make available, less you are catering to data privacy kind of regulations. So finding that intricate balance is much more of a challenge in Southeast Asia than perhaps it is in the Western world, where you already have high credit penetration levels. I also think that the challenge associated with all of this is, in some form, the ecosystem coming to play. Making sure, for example, various players are coming together in a mutually beneficial model that seems to make sense. I can perhaps talk a little more about this with this partnerships hat on. But one of the challenges that we are seeing from experience standpoint is, the data ecosystem is wanting to take its pound of flesh. The lenders are wanting to take their pound of flesh, and for all of this to come together in a way where we are able to find that middle ground, where we have a clean, good digital product being available to a consumer, is, I think, the next challenge. And I think the last thing to mention perhaps is also the complexities of these new tools at play. I mean, while we are talking about the advantages of things like artificial intelligence, ML tools, and so on, the negatives are also the fact that some of these create black boxes, could create issues around fairness. They might end up lending to segments that you've already always been used to lending, rather than to new segments and supporting financial inclusion like you'd want them to. So I think it's the coming together of all of these problems that poses a sort of a unique challenge in the Southeast Asia APAC context than it does in a typical developed world ecosystem.
Okay, so I think we've mentioned consumer education a few times. Can we maybe just tease out that point a little bit? Like, when you're talking about consumer education, what specifically are the typical gaps in terms of knowledge that you're seeing, and what does it end up leading to as a result?
So, one of the things that we are seeing is clearly the issues of over leverage. Making sure that consumers are aware of the fact that consumer purchase decisions that are now easier to make. You have a checkout tool that lets you avail credit at point in time very easily. That process also makes leverage a little easier. Also, over leverage that much easier. So I think that's the one piece. I don't think there's an easy solution there. One is for consumers to be aware of their leverage, their repayment capabilities, but I think regulation is something that you have to catch on, and perhaps some level of self-regulation from the players might help in putting some of these pieces together. I mean, we are seeing, for instance, players like Experian playing a little more of a relevant role in ecosystems around creating, say, a kind of a credit bureau that looks at consumer leverage across different players. So the first loan might not tip them over, but the fourth or the fifth loan might. So just making sure that before the lender takes a decision, this information is available is, I think, a key part to making that decision.
Sorry, can I pause you really quickly? I mean, I just want to get some of the other speakers involved. I would love to hear your feedback on this particular issue in terms of consumers over leveraging themselves. Either Arvid or Ankur.
Right, Ankur.
Sure. Yeah, let me jump in. No, I think consumers over leveraging themselves, yeah, it's two sides of the coin, right? Like you have markets like Singapore, Malaysia, where there is pretty high credit penetration. Whereas, in markets like Indonesia, as Arvind was also saying, 1 out of 10 or 9 out of 10 consumers don't have access to credit cards. So there is a significant balancing act to be done. And how do you manage these aspects? Of course, education has a role to play in terms of really being clear on affordability. What does affordability mean? Whether it's in a buy now pay later product, or if it's for SMEs, we have embedded debt service ratios that are embedded into our algorithms, right? In our automated underwriting standards. So if a merchant, if a small SME is making X dollars on our platform, we are not going to be giving him or her a credit facility which will extend beyond what he's able to service with just the money on our platform, which tends to be a fraction of the total money that this person or individual or SME would make. Now, on the flip side, when it comes to consumers, you really have to do the education a lot more, whereby this is your monthly service, debt servicing that would be required, articulating that very clearly in our sort of contracts as part of that checkout. When we do edge decisioning, that's the edge education also needs to happen, right? Which is letting the customers know and the consumers know that your repayment amount will amount to $120 per month. So your disposable income needs to be at least some 4x this to be able to afford this item at point of checkout. So these are things that we are exploring more and more and investing more and more as well at Grab as we extend our buy now pay later products beyond Singapore, Malaysia to other markets. But in many of our products, which is on our merchants and our driver side products, it's very much embedded within the product itself. Before the merchant can check out, take a loan facility, we make it very clear what the amount would be, and we make it a point not to over leverage them. Yeah.
All right. So then let's talk a little bit about the where the digital credit industry is going now. So any expectations or possibilities that you're looking out for in the next 2 years' time, and specifically any regulations that we're also keeping an eye out for? Arvid?
Yeah, sure. I can share a little bit from the perspective of let's say a digital bank, and I think the starting point for us is when you take a look at digital banks globally. There's obviously a lot of them. There's over 250 digital banks globally. Only a handful actually have been successful or profitable. They've largely been successful to scale. I think curiosity is one of the drivers there. Some of them are more, let's say, single product propositions. It could be in payments, in lending, in accounts, that kind of thing. But I think there's common denominators of the successful ones. Actually, 13 out of 250 plus have actually, quote, been successful, meaning they've shown profitability. 10 of the 13 actually sit within Asia Pacific. So there's some learnings there. And I think the learnings we found are across 4 dimensions. That first and foremost, you need to be able to solve pain points in large markets. And I think examples around financial literacy and credit, it's a pain point. We've seen a new bank in Brazil that's where there's largely unbanked customers actually drive from that angle. And the same is happening in some of the markets here in Asia Pacific, where that's the driver, whether it's on the consumer side or the SME side. Second is credit. I think profitability for digital banks is very tough to get towards path to profitability without credit. I think diversification of revenues is important. And the credit supported with alternative data is, I think, the key in order to accelerate that path to profitability. Related to data is ecosystem partnerships. There's plenty of examples where this reach in ecosystems has enabled that. Like Ankur mentioned, I think Grab is just one example, but there's many like that, where if you can lever the wider reach and data from that, partnerships are key to extend that reach and get customer acquisitions, and then actually through data get credit in there. And lastly is the lean operating model. Now, I think that comes in 2 parts. One is the unit economics from a customer profitability perspective. Like Ankur mentioned, cost to acquire, cost to serve, they all need to be low, but you also need to deepen and engage those customers across a range of different products. It's not credit alone. You need to take that customer on a journey on financial literacy. And I think there's a lot lacking there. Back to the point that was mentioned before, we've done studies and deep dives with customers, and it's fairly shocking to see how little some know comparatively, which is why we've really tried to embody our brand promise to be simple, engaging, transparent, and have that resonate within the customer journey. So whether it's our T's and C's, whether it's the journey and how we operate, we want to actually provide them the kind of tools that give them that transparency. For example, real-time expense tracking is a feature we put into our journeys to give people that understanding of what is their financial situation at any point in time. And I think tools like that can help customers credit groom themselves in a sense and get right payback behaviors and really get them on a track to where they can actually be independently financially secure.
Okay, if I might ask a amateur question, but do we have proof that that level of customer education and engagement works and is actually producing the benefits that we would expect to see from it?
So I can speak on behalf of Tomorrow. I think digital engagement to us is at the heart of what we're trying to do. This may seem like a bit out of the way metric, but one of the key metrics we actually follow is NPS, Net Promoter Score, to make sure that what we're delivering meets customer expectation, whether it's onboarding, whether it's our digital serve, whether it's our overall relationship NPS. And we've seen that there's a really high correlation between NPS and the kind of relationships people have with the bank. So when we're onboarding these customers and we further digitally engage them, there's direct correlations with the kind of engagement and the kind of product holdings they have. So from our perspective, it works. It's a path we've just started. The jury's not fully out, but I think we're starting to get on the right track in order to prove our hypothesis right.
Right, great. Any other thoughts on this topic, or shall we move on? Sorry, Mohan, I think you're muted again.
I was just going to say there's one other thing that I might add to the mix in general, which is broadly around the theme of consumer education translating also to easy availability of, let's say, their consumer credit footprint. I mean, one of the things that has to happen in parallel to some of these credit systems growing is each consumer being able to see what their credit footprint is and making sure that that's transparently available. I mean, we find this, for example, one of the bigger issues as the industry goes. For example, Bnpl as a sector is part regulated, in some places is fully regulated. Digital banks obviously are part of the ecosystem, which is useful. But making sure that the consumer is able to see their entire footprint in one place is useful. And I think that's a start point to their education. I mean, the moment they are in a place where they can see all of this, make sure that, for example, there isn't anyone sort of using their credentials fraudulently in a digital space to take a loan, or making sure that all of those loans and the implications of those loans from a score standpoint, etc., the way the credit system sees them is available in one place. I think it's something that's immensely useful, and that also leads to the consumer taking a little more control of their credit footprint, which I think is genuinely what consumer education will have to go to, especially in the digital world.
Yep, totally fair. Okay, let's switch gears a little bit and maybe talk about some of the tech changes that we're seeing in this space and how they're evolving. So AI ML has been brought up a few times. Obviously, the benefit of AI ML is that it allows you to grapple with these vast quantities of data in a much more efficient and streamlined way in order to produce those insights that you're looking for in the digital lending space. So Mohan, if we can stick with you for a second, what are some of the different approaches of implementing AI ML solutions that would be most efficient for a business?
I think it depends on what's easiest for the bank or the financial institution to implement. I mean, what we are seeing is implementations where, for example, there is a very clear sandbox of sorts that's put together. That's a sort of a development platform, which then graduates into a production platform. We find that the sandbox approach is quite productive because, for example, it can also let you think of new products, capabilities that you can put together fairly quickly. get perhaps the regulator involved. I mean, APAC has APIX as a platform, for instance, that MAS as a regulator is involved in. It's a very good way of thinking about trying to use ecosystem capabilities all together in one place, trying to put products that get regulatory scrutiny while you're taking them to the consumer. I think the other way of thinking about this is intrinsically AI/ML systems also have the necessity to be fine-tuned, to take care of auto-improving them over a period of time. The biggest benefit of AI/ML is in some form you can iterate and build scorecards faster. Now you need at some point, at some level of human intervention to figure out at what point in time you want to graduate them through to production. So the staging systems, I think, is starting to become another key feature of the way we are starting to see people evolve and put together their models. The last piece to the puzzle is ensuring that there are things in place to take care of checks on the fairness of the model, transparency of the model, and so on. That also has to be intrinsically a part of the development process. Unlike in a regular scorecard development where you would already do that by way of the people involved, here you actually have to rip open the black box at some point in time to make sure that it's holding up to scrutiny of fairness. And I think that's sort of last component, to the whole stack that you need to put together. So we are seeing different approaches, people taking slightly, varied approaches. I don't think there's a single stack that works. I think what works for an organization is what puts together all of these components fairly well for them.
All right. Ankur, maybe if we can go to you. So can you share about how AI/ML helps you all parse the data so that you can be more responsive to market changes? For example, I mean, I don't know, but like if Grab is deciding, or GFG is deciding to whether or not to lend to like a particular restaurant, does the potential like lockdown in that country make a difference? And would that data end up reflecting in your model and allowing you to make like a much more like nuanced decision in that moment?
Yeah, absolutely. Thanks. And many things what Mohan was saying resonated as well. But before going on that, on this specific question, like it's super true for us. Like that's actually one of the key differentiators for a platform such as Grab and how we do lending, which is whitelisted base of consumers or merchants who are underwritten and provided a loan facility, and that whitelisted gets updated in real time based on real-time data, based on real-time insights that are being fed in. And even before, I mean, per se, of course, if there's a lockdown that's announced, then that's something that will require human intervention. But even to change the models, but even if that doesn't happen, the system will detect that the revenue or the sales of these merchants are changing from one platform to another, or it's mostly becoming delivery rather than say through Grab payment. And how we will predict and how we will provide a loan, the loan quantum will change based on that. Whether they are in the right radius, whether they are based in an office building where most of their sales happen through lunchtime, that will determine and will auto reconfigure the credit sort of underwriting standards in real time. And that's the beauty of our system, right? Because it's designed from day one on using alternative data, using our ecosystem data. It is not dependent on, hey, give me your what happened 2 years ago in your sales contracts or your bank statements from last 6 months. It's based on real-time data. A perfect example of this is our merchant cash advance program in Thailand, which has been very successful. We partnered with BOT on this as well. It's a fully automated system end-to-end from underwriting. The merchant sees this credit line available 24/7. When they need it, they click on it. Instantly, there's cash available to them. And the deductions start happening through the sale on Grab platform itself. There's no human intervention needed in terms of calling to collect. It happens through their sales on our platform. And the merchants don't need to go to a 7-Eleven or log into a different bank account to repay. It just directly gets deducted from their flow in our system itself. This is an amazing program, and it has helped so many of our merchants during this time. The third piece where AI, machine learning, and automation comes in very handy and often overlooked is in the collections piece, right? Like when we have a call center and a collections team, oftentimes you see that growing linearly with the book, right? What we want to see is the collections team sort of growing, there being a second derivative, more curvature to that growth in a way. And that is where AI and machine learning can help. My same 10 call center, 20 call center people can service 10x more consumers because we have many different kinds of collection seek scorecards. We know which type of customer will react at what time of the day to what mode of communication. It's not just about call. Maybe someone just needs a nudge through SMS, maybe through our in-app systems. All of this is based on our machine learning based models built by our own data science teams in-house, right? And that really gives us another edge as well. Of course, there's a lot more which I haven't touched on beyond this, which is the fraud, data input, consumer education, the nudging, selection of what items in a Bnpl product you want to market, ads, many aspects as such. But I've just touched on 3 key areas from a lending lifecycle point of view.
Yeah, I mean, super interesting. Thanks for those examples. Ed, to come back to you, obviously, modern digital lenders, the personalization is a big deal. And so I think the models, a lot of them had like generic assumptions or like outdated assumptions that used to underpin these credit risk models. And this has basically been turned on its head. So for you at Latitude Pay, can you also share any examples or case studies of how you're using this sort of data and cloud-based solution to power consumer insights in this personalization aspect?
Yeah, of course. I mean, as one of the newer entrants, right, and a pure play Bnpl player in the market, like we don't have the benefits of a massive database, like Wrap have to draw insights from. So we are forced to innovate on how we assess risk in real time and still meet customer expectation. And this is really something like, if you look back 3-4 years ago, it's really something quite unthinkable, to be able to compete with a large, consumer player that have, massive data reservoir, but with the emerging, digital ecosystem, we can now really integrate with a multitude of vendors assessing, alternative data. I think Uncle mentioned some of them, like mobile phones, social medias, biometrics, and there's all sort of behavioral data, and they're incredibly predictive. In the absence of what Mohan said, the lack of transparent credit, footprint, right? And with those information, even like a newer fintech can now build really fully automated end-to-end digital journey for consumers. And for us, we're more specialized in enabling our customers to make larger ticket purchases. Our average sales are over $1,500 per transactions. And many of our customers are responsible spenders, but because of the lack of credit history or maybe like they don't meet certain requisite income threshold, we actually end up being their first source of credits. And this happens really because of newer emerging data set that really weren't available even just a few years back. And they really are able to make a difference on how we're able to manage very better than credit card charge-off performance and still result in a customer experience that's real time and at the point of sale.
All right. We have just a few minutes and we actually have a bunch of great questions that I want to make sure we get to. So maybe we can end up this particular our combo, which is the few final words and thoughts. So Mohan, first to you, can you share with the audience? I mean, we've been talking about a bunch of different data solutions, tech solutions, but what should they be looking out for when they're choosing or investing in a digital decisioning solution for themselves? Mohan, you're on mute again. Or frozen. Okay, all right, we're gonna keep going. Any other thoughts? Mohan, are you back?
Can you hear me now?
Yes.
Perfect. So sorry, I was just saying that it sort of plays to the point that Ankur was making, which is, in a way, what you need to do is to make sure that there is end-to-end process that you're able to build. You look at the three components again. I mean, I'll go back to the basics that I was talking about earlier. I mean, what you need is something that is a platform that brings all data sources together. The reality is, in the past, you would think about a data lake structure that bring this together. But today, what you are depending on is not just internal data, but also partnership data. So we almost think about this as a construct that you need to put together, which will have access to data that you have, but also give you the ability to loop in data or bring in data from outside, from partnership ecosystems. That gives you a sort of single view of the consumer. It might be a system that lets you ping a place to get data and so on. So this is the sort of data infrastructure. On top of the data infrastructure, what you need is clearly a set of tools that let you do the build of these scorecards. Internally, for example, we have our products that we call Ascend and Ascend Intelligence Services. So what we do is take an approach similar to an app store of trying to build different applications. Again, you could liken it very similarly to what Ankur said. There might be different use cases. So what you have is a different app that builds for different use cases, continuously monitors these scorecards. The third piece is actually the edge decisioning component that I mentioned, which is now that you've got the data, that you build the models, you need to still push the models to the edge where the decisions are actually getting taken. So let's look at these as decisioning systems or your cloud-enabled systems. What you need is something that will move these models and host them there and make them available when you need them. So it's a combination of these three pieces that we think of as a sort of essential ecosystem. And this sort of build also a virtuous cycle because it lets you use the data to again improve the scores, to again get it to the place where you're deploying them. And again, the deployment data gives you enough information to be able to make the circle virtuous. So in a way, I think it's these components that we sort of see bringing together that we think makes a lot of sense in the new world as core infrastructure.
All right. And to my other panelists, maybe if you can all just name one thing, either an innovation or opportunity that you're keeping an eye out for the next 2 to 3 years. Arvid, if you want to go first.
Yeah, sure. So I think honestly, it's just innovation, and I think innovation is a general theme within Tomorrow that we try to own. We set aside mental space, we set aside capex, and we set aside opportunities to actually follow this because banking is obviously changing very quickly, and it's a landscape that changes almost by the month. So actually that spirit of innovation, whether we embed that culturally or from a business perspective, I think is something that we continuously strive to achieve.
All right, great. Ankur?
Sure. Real quick, I think for our takeaway in this really is the ability to leverage insights and high frequency data, right? If one thing that the pandemic has proven to us is the need to be online, need to be digital, need to have a digital footprint. Whether you're a small business or a consumer, when times are tough, that is what will help institutions such as ourselves or the banks or many other financial services partners to be able to provide you the solution and the service that you need. And that's what helped us. And that's what's going to continue helping us in advancing financial inclusion in the coming years. I think the other thing to really watch out is just partnerships between more and more ecosystems, such as ourselves or other players who are ecosystem players and the merchants, providing some solution to the merchant ecosystem on the supply side or on the payment side. That opportunity is just going to blossom a lot more in Southeast Asia, in my view.
All right, so the importance of partnerships and then helping them help you, basically.
That's right.
Ed, over to you.
Yeah, I think it's quite eye-opening to see, the revolution in the way that our merchant partners are now thinking about digital. It's really no longer an add-on additional channel for them. And, suddenly they really understand this is really the future. And now it's possible for the entire credit offering to be digitized and embedded, in their checkout flow. And we are really here to be the gatekeepers to enabling that, to giving them the support and expertise. And I think in 2022 and beyond is really just try to catalyze new ways of working between the incumbents and the fintech companies to really drive the pace of digital credit adoption much faster than we could have really anticipated before. The next phase of growth is really just bring together all the different ecosystem into one collaborative space, and hopefully it's more consumer friendly and more sustainable.
All right, great. Okay, we have a bunch of questions, so I'm going to try and group these up. Maybe we can move efficiently through them. So one topic is alternative credit scores. So as a provider of alternative credit scores, how do you ensure that your recommendations are of good quality and adding to the value of the customer? And then a follow-up to that would be for Ed specifically, how do you evaluate and qualify vendors that sell alternate data? I think anyone can jump in on this. So yeah.
The score quality piece, it's a bit of bread and butter for us. I mean, I think the easiest way to think about this is at the end of the day, the insights that we referred to earlier need to be something that sufficiently differentiate the consumer. So at the end, for instance, if you're trying to look at credit, you need to be able to figure out what's good credit and what's bad credit. There are internal measures that most organizations use, to look at what the quality of a scorecard is. We refer to them as Gini, which is basically the differentiation between the goods and the bads, so to speak. Typical Ginies for a good scorecard will be in the sort of 30-35% zone in this part of the world. What we find is with alternate data, if you can get to something in that threshold and beyond, you are in the technical space where you have a good answer. You can use that score for consumer decisioning, and it will not result in more risk into your portfolio than you want. So I think that's the easiest way of thinking about it. There are lots of other nuances to this, like for example, micro segmentation. You might want to make smaller and smaller segments that you might be able to take better decisions on, and so on and so forth. But I think the easiest way is to equate it to real world situations, real world implementations that we have right now, and just equate it to your current scoring systems and look at cutoffs that are above what your appetite for risk are at this point.
All right. And then Ed, how do you evaluate and qualify vendors that sell alternate data?
I think we generally have two guidelines, right? I think one Mohan touches on is really data that really is additive to our current models, lead to higher approval, lower expected losses. And second is really making sure that the score has a clear use case and is not discriminatory, and hopefully the outcome leads to a much more fair and objective distribution of credit rather than just a small percentage of people getting into over leverage. So those are sort of general tool rules that we employ when we look at alternative score providers.
Okay. We have a few questions on regulatory issues. So what sort of regulatory challenges, if any, are each of you facing in using consumer data that's gathered primarily for other purposes? So specifically on corporate grab, potentially food and transport, and then you applying that sort of data over to the credit granting process.
Yeah, just quickly on that point, I think the key there is ensuring that you have the right sort of consent framework for getting that data and leveraging that data for underwriting purposes. And that's something we religiously need to follow and obviously engage with regulators on. There's no two ways about that. Yeah. So having the right consent framework, basically.
Arvid, I saw you nodding along. Do you want to weigh in on this one too?
No, for sure. It starts with consent, obviously, and I think that regulations, obviously, there's different levels of engagement or expectations across countries. So regulators need to be kept in very close touch. Data is sensitive, especially as a bank. We're very careful, and data sharing amongst partners. This is always a sticking point. Aside from customer ownership, commercials, intellectual property, and things like that. So it's I think data is if we can solve that in a way where there's transparency, fairness, and consent, obviously, then I think that's a crucial stepping stone to enabling this.
All right. I think, can you each share maybe the balance of like, I mean, we've been talking about like alternate data sources in terms of the credit rating system. Can you share maybe the balance of like the traditional credit scoring metrics and like, you know, if you're building out that algorithm, what percentage is weighted on which side, the alternate versus traditional scores?
I can start maybe. So I think we're obviously starting to get into the alternative. We're doing this in a very ring-fenced sandbox environment. So we're conducting a whole range of credit tests across markets and across customer segments that really qualify and validate the approach. Once these have been validated, they get further scaled out as broader market propositions, so to say.
Okay.
I'll just share some thoughts on that. Of course, you know, for many institutions and financial institutions, banks, where I spend considerable time as well. Historically, you would start with a traditional scorecard, and based on the consumer's profile, based on all kinds of information on the consumer that generally, institutions such as Experian and FICO have historically built a scorecard. For someone like us, we started really with alternative credit data and then triangulated with a traditional scorecard. And there's some spectacular insights that we got in many instances. So alternative ecosystem data could actually, in many times, lift the Gini score of the scorecard by a good, double-digit percentage points. What that translates for a bank or financial institution is a real dollar savings as well in terms of credit loss as such. I think there's some interesting balance to be played. It's not about just one or the other. It's more, I think, about what you have and what you can start with. For a newer financial fintech companies, you have to start with alternative data, and just because you don't have that historical data perhaps, or you don't have the luxury of being able to, you're never going to be able to do edge decisioning if you have to pull a scorecard from a bureau and then make decisioning. Of course, with the help of Experian, there are some more tools that are allowing for that at the moment, but that's a more tough proposition.
I was gonna add my 2 cents as well. I mean, traditional scorecard model is much more focused on someone's ability to pay, right? There's a much more heightened focus on income and past credit history. So someone that had bankruptcy, for example, generally it's just a flat out no for a lot of financial institutions. But with the benefit of alternative data, right, you try to look past that, right? Just because someone that had no credit history, or maybe their income might not be, fit what like the normal definition in these days, right? Like there are a lot of, gig workers now that have income, but they don't necessarily have like the traditional income with CPF. Does that mean they, should they qualify for credit or they don't? So this is where the alternative credit plays a big role, right? When, the lack of, credit footprints, hurts someone's ability to get credit, whereas alternative data gives them another chance to kind of like assess their credit risk, for who they are now rather than, what they were in the past.
All right. And we're just about time. So just 1 or 2 more questions before I let you all go. So one would be like, obviously we're talking about lending and presumably part of the big benefit for the actual consumers is reduced interest rates. So Alberto is asking how, and maybe I'll adapt this, but how does any of this new digital lending, how can it help address the relatively high interest rates that are applied to consumer loans in the lending space, in particular in Indonesia, which has some of the highest net interest margins? Is that like a stated goal of the digital lending space, is in order to help reduce some of the interest rate as you're starting to understand your consumer and their particular profiles a little bit more?
Maybe I'll start. I'll kick it off. I think 100%. It's in many markets when you're starting with a blank slate where you do not know the consumer. The tendency is let's charge as high as possible so that we can cover our risk, the downside. But as you, and that's where the role of alternative data, ecosystem data, better consumer insights from various channels, that's where it has a role to play. Once you understand in the segment of consumers that may not have have traditional scorecard at all, may not have past credit or history at all, but through alternative scorecards, you're better able to understand them and realize that they're not really a high risk candidate. Why should you be charging them the price or exorbitant rates, which you would charge someone who is actually a high risk person or a high risk candidate for lending, for borrowing, right? So this is where I think, cutting it with where alternative data allows you to cut or make credit risk decisioning with, cutting it with a finer cloth rather than, it's basically sharper decisioning rather than more based on historical info. Yeah.
All right, and last question I'll ask is, I guess this one will go to Ankur and Ed. So how do you address the credit and fraud risk of high-risk product categories in Bnpl, such as mobile phones or jewelry? Obviously, different players take different approaches. Would be curious to hear what you two are thinking about at your companies.
I'm happy to go first. So we actually, those are segments that we like to traffic in. And most of the risk associated with mobile phones or jewelry has less to do with credit, but more with fraud. And that's really where a lot of our resources have gone into is for you to build a sustainable business in those segments, you actually really have to minimize the fraud risk that occurs there. And the reason why the fraud risk is high there is because those are segments, the products themselves are very liquid and they can be monetized easily, which attract a lot of fraudsters in there. And so yeah, so I think, and this is also where the digital journey helps in many ways to combat some of this fraud issues, right? Because I think anytime you go through the journey, you are leaving a footprint, right? Some of these can be devices, it could be just a behavioral thing. Whether you're web browsing or doing this on a mobile phone, it does give a sense of who you are, for digital identities. In many ways, all we try to do in our approach is really just to find consistencies across different data sources. Usually, fraudsters does, have a very different way of, going about getting access to Bnpl from a legitimate users. So we think that, if you can solve fraud problems, especially on the prevention side, then, this is actually a segment that, there's a lot of users that want credit, and because of fraud, they end up paying a higher, interest rates, if we will. And I do think this is a problem that should get solved, in the next few years, as we've seen in other more developed countries.
Sure, I'll quickly chime in as well. I mean, fraud is a problem across the board in Southeast Asia and many platforms, right? Even before Bnpl at Grab, we've been tackling fraud for quite some time when it comes to just drivers and incentives that are given to drivers as well and consumers. That's has been there for a long time, including GrabPay in countries and other markets. And our fraud rates are one of the best in terms of in comparable peer metrics when it comes to just the platform itself. So we're grateful that we have the platform to protect us. The Big Brother Grab overall platform helps me manage my risk from a fraud standpoint. Nonetheless, these two categories are a pain point, right? These two categories, for all the reasons Ed mentioned, is a pain point because it's high. Again, the liquidity and ability to resell these items are high, and the price is relatively stable. So, I mean, for us, it all starts with knowing the customers and putting the customers first. As long as there's a history and track record of this customer. In our cases, we do these products more heavily with our drivers and merchants. So smartphone financing for drivers is actually a key category that we have, and a separate program altogether in our Buy Now Pay Later program. And our merchants as well, because they need these instruments for their regular sort of to go about their jobs. Gold as well is another product that we are financing in countries like Thailand and markets where they value gold. But again, it won't be for a first-time customer.
Okay, awesome. That is more than time that we have allotted. So thanks to everyone for staying on a few extra minutes. Panelists, thank you all so much for joining us. And I've learned a ton. Thanks for sharing your insights and your wisdom in this area. It's obviously super exciting. And definitely, I think we'll see continued evolution, a lot of innovation in this space. So thank you for your time. Everybody who attended, thank you for joining. Hope you all learned something as well.
Thank you, everyone. Thanks,
everyone. Thanks all.
Bye, guys.
Bye.